6 months ago, I gave an AI $10,000 of real money and told it to build me a stock portfolio, not a simulation, not paper trading, real money, real positions, and real consequences. I documented every recommendation, every reasoning chain, and every buy and sell signal it generated. And I tracked the results against a simple S&P 500 index fund running in parallel with the same starting amount. What happened over those 6 months was not what the AI hype machine would have you believe, not what the AI skeptics would have you believe either, and genuinely more interesting than either narrative. And here's exactly what occurred and what it taught me about AI investing and the gap between impressive sounding and analysis and actual returns. How I set it up, the rules were simple and deliberately constrained to make the experiment meaningful. I would use a large language model, the same kind powering most AI tools people are currently excited about to analyze stocks, generate a portfolio, and recommend trades. I would never override its recommendations based on my own opinions either. I would execute whatever it told me to execute. Document the reasoning it gave and run the experiment for 6 months before drawing any conclusions. And I started by asking it to build a 10 stock portfolio optimized for growing over a 12-month horizon with moderate risk and tolerance. I gave it access to public available finance data, earning reports, analysis consensus estimates, sector trends, macroeconomic indicators, and asked it to explain its reasoning for every pick enough detail that I could evaluate the logic independently. The portfolio it built was on the surface coherent and diversified across sectors, heavy on technology and healthcare, which it identified as the two sectors with the strongest earning growth trajectories. A mix of established large caps and mid-cap growth names. Nothing exotic, nothing obviously wrong. It looked like something a reasonably well-read investor might construct after a few hours of research. And that appearance of coherence, it's the first important observation. And it cuts in two different directions. The first 3 months looking smart. For the first 3 months, the AI portfolio outperformed the index fund, and not dramatically. We're talking about 4% points of outperformance on a $10,000 portfolio, which is roughly $400 in real dollars. But consistently, though, and in the right direction. And three of its picked picks performed significantly above market, and two were flat. Five were slightly negative, but not catastrophically so. And during this period, I found myself doing something I hadn't expected, looking for reasons the AI was right. One of its picks jumped 15% on earnings. And I went back and read the AI's original reasoning for recommending it. And the reasoning was plausible. Post hoc, it looked precedent. And the company had exactly the margin expansion and the AI identified as a catalyst. The AI had been right, and the rightness felt systematic rather than lucky. This is the cognitive trap at the center of every investment strategy, and that appears to be working. Early outperformance indistinguishable from the skill, and the market goes up and down in ways that will almost any strategy look smarter over a 3 month window if the macro environment incorporates it. And the test of a strategy is not whether it outperforms during a favorable period; is whether it outperforms consistently across multiple markets and conditions over a time horizon long enough to filter out luck. And 3 months of outperformance felt significant, and it wasn't. Months 4 and 5 where it got interesting, though. Month 4 bought a sector rotation, technology, which the AI had heavily weighted, outperformed the broader market as interest rates expectations shifted and institutional money moved towards value and energy. Three of the AI's largest positions dropped 15 to 22% in 6 weeks. And the index fund, being diversified across all sectors, absorbed the rotation much more smoother. And I went back to the AI and asked it to reassess the portfolio given the changed conditions, and what it produced was coherent, detailed, and internally consistent. A well reasoned argument for why the technology positions remained attractive on a 12-month view and why the rotation was likely temporary. The analysis sounded exactly like the analysis a skilled human portfolio manager would produce to justify not panic selling during a drawdown. And here's the problem I couldn't fully resolve. I had no way to know whether this reasoning reflected genuine predictive insight or a sophisticated sounding rationalization for staying the course regardless of the condition. Large language models are extraordinarily good at producing convincing explanations for almost any conclusion. The quality of the reasoning as posed is completely independent or whether the underlying prediction will prove the correct. The AI can explain why a stock will recover with exactly the same fluency and confidence it would use to explain why it will continue falling. And both explanations will sound equally authoritative. And this is the core limitation of using AI for investment decisions that most people who haven't used it this way don't understand until they do. The 6 month result at the 6 month mark, the AI portfolio was down 3.2% from its starting value. The S&P 500 index fund running in parallel was 6.8%, and the gap was just over 10%, 10 percentage points, roughly $1,000 in real dollar terms on a $10,000 experiment. And the underperformance was not catastrophic. It wasn't a disaster. It was kind of of results that in a longer experiment might reverse, and the technology positions the AI favored could absolutely recover and outperform over the next 6 months. But the results over this window was clear. A simple passive index fund beat an AI generated active stock picking strategy by a meaningful margin without requiring any analysis, any reasoning, or any ongoing attention or any decisions at all. And that outcome won't surprise anyone familiar with the overwhelming body of research showing the active management, whether by human or machines, underperforms passive index investing over most time horizons. And after fees and trading costs, AI replicated the most common failure made or mode of active management, conviction in specific positions that caused sector concentration, which amplified losses during sector underperformance that broad diversification would have absorbed. What AI is actually good at investing, though, none of this means AI is useless for investing, okay? It means it's useful for different things than stock picking, where AI generally earns its place in an investor's toolkit is in research and efficiency, and not prediction. Asking an AI to summarize a company's last five earning calls and identify recurring themes in management. Guidance is useful. It compresses hours of reading into minutes and surface patterns that are easy to miss. Asking it to explain a complex financial investment, using it to generate questions you should be asking about a company before investing is one of the most underused applications available. And what it cannot do reliably is predict which stocks will outperform the market over the next 6 to 12 months, because that prediction require it to have information or insights that isn't already priced into the market by the millions of professional analysis, institutional investors, and algorithmic trading systems that collectively determine prices in real time. And the market is not efficient enough to be exploited by the same publicly available information that an AI can access and synthesize, because the information has already been synthesized and acted on by everyone else. What the experiment actually taught me, though, was this: the most valuable insight from 6 months of letting AI pick my stocks was not about AI. It was about the psychological appeal of active investing generally. The AI's portfolio felt better to own than the index fund. It had reasoning attached to it. It had a narrative. When positive moved there with an explanation for why they moved and a thesis for what would have happened next, the index fund just sat there, silently being diversified with no story to follow and no intellectual engagement to provide. Human beings are story seeking creatures, and the market provides an infinite supply of compelling narratives. AI makes those narratives more articulate and more detailed and more convincing, which makes the emotional pull of active investing stronger and not weaker. That's the actual risk of AI in investing. For most people, not that it will give you bad advice, but that it will give you very convincing justifications for doing the things that has historically produced worse outcomes than doing nothing. The index fund, it beats the AI boredom beats the brilliance, and that's not a new finding. That's been true for 50 years of index investing research. AI just made it freshly worth demonstrating. Thanks for watching. Like and comment down below and subscribe. I'd love to hear from you down in the comments section. If you really love the channel, feel free to buy me a coffee. It's in the description and on the main page of this site. I'd highly appreciate it. And check out this video on the right about more about financial advice for you and your family. Thanks for watching, and we'll see you all the next one.